Okay. Good morning, everybody. Thank you very much for coming along today. I was speaking with my good friend Ian Hyman here. Actually, I was talking to all of us yesterday. We got on a Zoom just to have a bit of a chat beforehand. And of course, the question is always who's coming. And one observation that Ian made was that whoever it is that's coming, are serious folk, the best of the best who are going to get up at 7:30 in the morning and come along to a session like this. So we know that you're all red meat eaters and rainmakers. So thank you very much for coming along. And we're going to have to be on our toes, guys, because we've got some serious players in the room here that know the ins and outs of mergers and acquisitions and play in the equity space as well. So this isn't going to be a walk in the park, fellas. I'm sorry, I know that's what I promised. I guess one thing that everybody has in common, we're all people in the finance game in one form or another. You know, if it is equity or it's as brokers or as lenders, and we want to write deals. Let's be honest. Obviously, we want to help people. I mean, as I've been listening to a bit of Zig Ziglar lately, we want to get what we want by helping other people get what they want and all that sort of stuff. So one of the sectors, one of the reasons people need capital is to grow their businesses or to buy businesses and to grow their businesses through acquisition. So what I'm hoping that you get out of today is firstly, what's going on in the world of business acquisitions at the moment? What is there in the economic environment, the situational environment? I know that when GST came in, it was a long time ago, and I think also with COVID now, there are people that are sort of on the brink of exiting their businesses. They may be crusty old age, such as myself, and they've been thinking about selling, and then COVID or GST in that case came along and they go, you know what, I can't live through another one of those. I need to get out before the next one comes along, having survived that. So there's a little bit of that, I think, maybe. There's some strategic issues with growing, of course. You can grow your business organically. But once a business gets a little bit of momentum and they've got the ability to raise a bit of money, then they start looking for growth through acquisition. And so that's what we're talking about. We're going to hopefully learn about maybe some of the regulatory things, or certainly maybe some of the legal bear traps that we want to avoid. Sometimes anticipating these things we can get through. And again, when Ian saw the list of things I wanted to get through, he said this is going to be a 7.5-hour session. So look, what we're really hoping for is when you're having a conversation with a client, in the very least, you'll be able to say, yes, I know about that. There is something more you need to know about it, because you're not going to have a photographic memory of everything we say here, but at least you'll know, hey, that's an issue. You need to look into that, and you need to get some advice. And so hopefully we'll be able to sort of help you guys expand the role of finance broker a little bit. I know one finance broker in Melbourne who got so involved in financing acquisitions and a bit frustrated with how they worked that he ended up getting he became a business broker as well. He got himself accredited with licensed as a business broker. All right, so we've got three panellists. We've got Ian Hyman, who's the principal of Hyman's Valuers and Auctioneers, national firm specialising in property, plant and equipment, and living legend Ian Hyman. We'll do a more of an introduction shortly. Andrew Casson, who's the founder of Casson Advisory, and he focuses on M&A specifically. He's all aspects of M&A, but his focus these days is on what we call sell side. We'll hear a little bit more about that, but Andrew's been doing that for over 20 years. Probably, if you're anything like me, it's probably been more than 20 years. My bio says 30 years in finance, but it's a little bit, you stop adding the years after a while.
I'm waiting for the living legend part.
Yeah, right, and a living legend, and an active living legend. So thank you very much for coming along. And we've also got Malcolm Campbell. And Malcolm is a principal lawyer at Coleman & Gregg here in Parramatta. He's got over 20 years experience in business, commercial, workplace, estate planning, and helping people with buying and selling businesses. And he's got plenty of war stories that he sort of touched on yesterday as we were going through. So I thought we would start, well, firstly I'll introduce myself. I'm the Director of Hermes Capital. I'm the fund manager and director of Hermes Capital. We've been going for over 40 years. We're a fund. I guess when we started off, I would have just said we're a lender, but these days it's sexy to say that you're a private credit fund. So yeah, we are a private credit fund. We specialise in special situations. We're asset-based lenders, so we lend against receivables, equipment, and sometimes second mortgage on property. Special situations include business turnaround, but they also include business acquisition. So we see a fair bit of that. I'm going to start by saying to everybody here, they'll introduce themselves. I'm going to ask them a bit of a question to answer as well. So Ian, if you could introduce yourself, tell us a little bit in a nutshell about yourself. Ian's also a business acquirer, I should say. But tell us a little bit about yourself, and based on your expertise, maybe you could tell us a little bit about industry sectors, what's hot and what's not at the moment.
Sure. Good morning all. So obviously the business's main focus is in the valuation space, property, plant equipment and business valuations. And that's right across the country, particularly on the P&E and the business valuation side. Property tends to be more East Coast. Markets at the moment are really up and down. We've seen probably about a month before the budget a real softening in plant equipment asset prices, used asset prices. All of those wonderful, I guess, inflated values that you were seeing through COVID and through the end of COVID have basically gone, and we're now seeing a lack of confidence and a lack of certainty on the P&E side. So we're literally over the last probably 4 or 5 months, asset prices in some categories have come down by 30%, and that's really affecting our valuations. And in recovery situations, for those people that lend at the peak in sort of 21 and into 22, sort of trying to get their money back is actually proving quite challenging. On the property side, resi, as we know, we just have to read the papers, is still pretty strong, but on the commercial side, we've seen clearance rates absolutely slump. In Sydney over the last sort of 4 to 6 weeks, commercial clearances have been in the 30 to 40% range, with a lot of properties not actually receiving any bids at all. I was speaking to a commercial buyer's agent the other day, and he said, if you want to get depressed, go to a commercial property auction at the moment. It's pretty sad. And certainly we've seen, I think, and obviously you guys know the story with the banks and the non-bank lenders. There's certainly a narrowing of appetite from where things were probably 6 or 9 months ago. The expectation, I think, towards the end of this year that we may see another rate rise, certainly no rate reductions over the next sort of 12 months probably, which I would support, and that's certainly the moment. Credit always tends to narrow when there's uncertainty. There's a fair bit of uncertainty at the moment.
What's your business valuation? Because you've got a valuation for branch, division. That's what I was looking for. What are they saying?
Mate, they're saying that, look, as rates go up, obviously yields and returns have got to go up, which means prices come down. So we have seen prices for the businesses that we're valuing for sale, or even where we're doing a family law valuation or shareholders dispute where we're trying to determine generally a minority shareholder's position, have definitely come back. And again, a lot of the funders that are in that space that will do sort of business sale funding have tightened up on their credit process, so they're not throwing the money around like they used to. Things like small retail, food, some manufacturing areas are really struggling in that space, struggling to find buyers. And if you've got a client who's in the mood to acquire, I think now is actually a pretty good time. If they've got access to funds, I think that there's a lot of people, and there's a lot of, I'm 65, I turned 66 in a couple of weeks.
No way.
I know, it's hard to believe. I turned 66 in a couple of weeks' time. We had celebrated our 40th year in business a couple of weeks ago. At my age, a lot of other people, I'm not, but a lot of other people are thinking now's a good time to be, getting out of things. So the baby boomer, there's a lot of baby boomer businesses that are closing down at the moment because there's literally no prospect of a sale, and I think that's a real challenge. But if you've got clients that are actually looking to acquire, now is a really good time to be talking to brokers, to business brokers, and making those inquiries, because you're likely to find businesses that are complementary to the client's current business that they can pick up for quite quite small premiums.
Okay, all right, thank you very much, Ian. Yeah, I guess what we're looking for is businesses that can leverage their current balance sheets to buy other businesses. All right, Andrew Casson, if you could just introduce yourself, Casson Advisory, and is now a good time to buy, or should businesses be looking at growing organically? And what's the primary motivation for people looking to buy these days?
Okay. Yeah, Andrew Casson, Casson Advisory. We do mainly working with business owners who, probably much like what Ian was just talking about, are at that stage in life where that big decision is upon them. Sell now and retire, or even younger, sell now and get into something else, which I would also see that. The big question is now a time to buy. Look, it's always a time to buy. It's just at the moment the motivations are a bit different. Organic growth is difficult. So companies that have to grow, particularly listed companies, the only real way they're going to do that is by buying smaller companies and adding those on. And with business valuations lower than what they have been historically, it's a good time for even privately owned companies to expand through acquisition as well. So if there's strategic gaps in your business and you want to plug those, then you might want to expand interstate or internationally. You might want to add service lines or product lines. Now's a good time to do that. But it's always, from a sell side, it's always the same stats. Doesn't matter what market you're in. It's always 1 in 4, 1 in 5 businesses are actually going to sell. So there's sob stories of people who are closing the doors right now, but that's not unusual. That's a reality, and it always is. So in good times, it's because their expectations are higher and they price themselves out of the market. In slow times, it's generally because there's not enough buyers around.
Do you find that people buying to acquire volume and growth? Are they buying to acquire capabilities? I mean, is there a common theme, or is it just a growth story?
Well, it depends on each individual company's strategy. My advice normally on the buy side is always going to be, you've got to buy right. So it's got to fill a strategic gap. So if you're buying for volume, you're probably going to keep it, but you're going to pay a lot less for that than if you're buying for capability or you're expanding into new markets, which is much more a strategic buy.
All right. Thank you very much, Andrew. Malcolm Campbell, please, just a brief introduction of yourself, and Coleman Gregg Lawyers. And then if you can tell us, as a lawyer, what are the most common mistakes you're seeing these days when it comes to legally structuring acquisitions that maybe people arranging finance might sort of be able to flag on the horizon before it becomes too consequential?
Yeah, absolutely. So, good morning, everybody. Malcolm Campbell from Coleman Gregg Lawyers. I'm a principal director at the firm. I've been at the firm now for 5 years. Prior to that, ran my own small practice for a long time, which we merged in with Coleman Gregg. Coleman Gregg's been around for 96 years now, probably well known to a few of you in the room. I, for all my sins, head up the commercial services team at the firm. So my day-to-day work is working with businesses through the whole gambit of what they might need, but particularly in the M&A space. What do I see as some of the most common or big errors? Not understanding the structure of the deal, not understanding what it is that they're actually buying or selling from a technical point of view, and that would then have a big impact on the finance element of it. Not doing enough homework beforehand, and then when they get into the detail, the devil's in the detail. Once they get down into that detail, they realise the deal's not actually what they thought it was. It's not as good as they might have originally perceived, but those things are only flushed out once they're looking at legal documents, which really is a bit too late in the deal. You've sunk a lot of time, effort and money into the deal by that time to then realise it's maybe not what you thought it was to start with. So yeah, doing your homework, being ready, understanding the structure of the deal, and making sure you're really well prepared. They're the big things I think are really.
Yeah, I guess it's, I can imagine, I'm sure you've had situations where someone's bought a business, they found that, oh look, I got screwed over, I'm going to go and see my lawyer and see if I can sue them.
Yeah.
Whereas it would have been smarter to go and see the lawyer beforehand.
Yeah, and look, I've got this, I love my metaphors and my little, cute sayings, but you're going to pay one way or the other, and you can either pay on the way in or pay on the way out, and paying on the way in is always cheaper. So if you go and get that advice from your suite of professionals, it doesn't have to just be the lawyer. We're normally at the end of the line rather than the start of the line, but if you pay for that advice up front, it's going to be a hell of a lot cheaper than being saddled with a deal that is not what you thought it was, or is not as profitable, or it wasn't actually going to fill that strategic gap that you thought it was. All of those sorts of things. That's a really expensive way to do it. So yeah, absolutely get that advice up front, and if it's not right, be prepared to walk away from it.
Right, yeah.
Don't continue with a deal based on that concept of sunk costs.
I guess there's an old saying, there's always option D, do nothing.
Yeah.
A, B or C, or maybe you should do nothing. It's interesting, I often get asked for advice. I mean, I'm just a poor, humble financier, I say to people. And I'm not insured for giving advice, but I am happy to be sued on one piece of advice, and that is get advice. So,
Absolutely.
alrighty, okay. Look, small businesses can't go to the equity markets to raise capital to finance acquisitions. Obviously, if you're listed on the stock market, or if you're a larger business, you can tap on equity markets. So they've got to look for other ways of raising capital. And aside from folks such as my good self, I mean, what are you seeing, Ian? I mean, you're being approached to value assets, value businesses. What are some of the ways that?
Look, I think there's certainly the traditional put the house on the line scenario, which still easy to raise cash that way, almost from even from the major banks, provided you've got a way of repaying it. But I think certainly there's much more appetite these days to rely on obviously debtors and P&E in particular to finance an acquisition, and we've seen quite a few done in that way over the last couple of years. There's also we've seen quite a lot of deferred payment arrangements where not so much bottom line but top line type incentive structures when businesses are purchased. So I'm looking at the purchase of a property valuation practice in Melbourne at the moment, and the base will be obviously there'll be an upfront payment, but the rest of the money will come sort of monthly over 2 years based on revenue, not on margin. So we're not saddling anyone with our overhead structure. We're just looking at the gross revenue. That's we'll work at how we make money out of the gross revenue. And we've got a pricing structure which seems to be culturally aligned with the pricing structure of the practice we're looking at buying. So I think the point that Malcolm made is really understanding the business before we go into it, and a good business valuation will tell you how that business is operating. And if you give them the sort of the Rolls-Royce instruction, which is that I want to know what makes this business tick, where are their margins in terms of can you look at our business, look at their business, tell us how our margins in particular align. There's no point going to a culture where we're a boutique firm charging more than the average and going to a firm that's a sausage factory and they're charging 20% below the market. So they're not going to work, and that's going to end up in tears. So over the years, I've personally bought 6 businesses in different industry sectors. 4 of them have been unmitigated, say, disasters. Let's just say they haven't lasted very long. I've managed to get myself out fairly early. And 2 have worked really, really well. So I've sort of started in my own right to get a bit of an idea as to what works and what doesn't work. And the documentation, the legal documentation is absolutely critical. And I think at the same time that you are talking to valuers, you are talking to your financier, you're talking, in my view, the lawyer is actually the most important, because it's not just about the structure of the deal, it's about how everything from employment agreements, all the way through to the contracts that the company has with its clients, all that stuff needs to be reviewed as part of that process so that you know that what you think you are buying is actually what you're buying. I think that's more important than the valuations or anything else, because that's where things, and I know from personal experience, that's where things can go wrong.
Yeah,
Okay.
I was just going to dovetail off
Yeah.
that. I'm doing 2 jobs at the moment, both for international deals, where they acknowledge the importance of doing that. So my job right now is just due diligence. All I'm doing is I'm not looking at the finances. That's not my area of expertise. I'm literally looking at all of the key contracts, the leases, the employment contracts, because people say, oh, we want to buy this business because they've got this great contract with whatever. But you look at the document and it's got a change of control provision in it, which requires approval from the other party for it to assign. So if you don't know that and you pay a premium for the business and then you go to settle and they say no, the other side say, no, we're not going to assign that because we don't like you or we don't know you.
Yeah.
What have you paid for?
So just on the subject of financing, I'm not going to ask this of Andrew just yet because...
I can if you like.
Sorry, no, well, because I know where Andrew sits on vendor finance when he's advising his sellers, and we'll get to that in a moment. So we'll get to that. We'll try and keep it positive before we get to there. Now, there's obviously when there's a business, there's always this goodwill component, and unless you're a large business, obviously the stock market will pay for goodwill, but generally most financiers in the SME world won't finance goodwill. So Malcolm, do you see you structuring or seeing much vendor finance?
Yeah.
And what's your personal view on that, both on the buy side and the sell side?
Look, it's great for the buyer. It's not great for the seller, but sometimes it's your only option. If the nature of your business is such that it is going to be difficult for somebody to raise traditional finance, and you want or need to sell, what other options do you have sometimes? And look, you've all got good and bad outcomes. I have seen it work and work well. I've also seen it fall on its face. The critical element, if you are going to do it as a vendor, as a seller, is your security. How are you locking in what is going on? And if you have a buyer that is not prepared to give personal guarantees, put up some form of actual real property or something like that, you need to be very, very careful. From the buyer side, it's obviously attractive. I think a benefit that a lot of people don't think about is it keeps the seller with a vested interest. So as a buyer, if you can structure it that way, it's easier from a raising finance issue, but it's also, in my opinion, more likely to lead to a successful outcome because you have someone that knows the business that still has a vested interest in it because they want their money.
Yeah, I mean, I've always thought it as a bit of win-win. Certainly at Hermes, we're happy to do deals where there's vendor finance. I know banks don't like vendor finance sometimes. Well, certainly they never used to. They might have come around a little bit lately, but we're quite happy if there's a vendor. We're obviously financing the business going forward, and we're happy to do a tripartite agreement where, because we're funding the cash flow, we're able to scoop out the vendor payments and facilitate that. The vendor then is trusting us as a financier as opposed to necessarily trusting someone who's only just walked into their life. Andrew, I know that you're not a fan of vendor finance, so I'll let you get that off your chest first.
I don't mind vendor finance if it's the only option, but it's got to be done well. Most of the transactions I do are larger than those that anyone's going to give personal guarantees. I mean, the security that's offered is usually against the business that is being sold. I don't mind vendor finance per se because it's not tied to performance. Earnouts I hate.
Right, okay. So
I
do you want to just
detest
differentiate between those two?
Well, earnouts are pegged, basic scenario. If you value the business at $10 million and they say, okay, we'll give you 40% now, and then we'll give you 30% at the end of year one and 30% at the end of year two if you hit these marks. And if you don't hit those marks, the money's gone. So essentially, someone's selling 100% of their business for 40% of the cash, and they might not see another dime.
Right.
And they might work their butts off for 2 years, and they would have been in a better position if they'd retained the business for 2 years than if they'd sold it. So earn-outs are tricky. I would rather see a staged buyout of capital, of equity.
Yeah.
So you sell 40% of the shares, 30%, then 30% with put and call options. At least you retain an asset, an equitable interest. But if you have to do an earn-out, then it's got to be done
So
well.
just to distinguish between the two, the earn-out depends on the performance of the business, whereas the vendor finance is a fixed number, come hell or high
Fixed
water.
number, and it's usually with an interest coupon as well.
Yeah,
Do
interest.
you want to
security.
just add something to that sort of?
Yeah, look, I share the view of earn-outs are problematic, and we were talking before about litigation and litigation funding. Earn-outs more often than not will lead to tears in terms of someone will be dissatisfied, and if they are not structured really well and understood really well by both parties, it will lead to tears. Either that the buyer will feel like they're paying for something that they shouldn't have to pay, or the vendor will feel like they're not getting money that they've deserved and put in the effort, and that they've been thwarted. I have seen many deals where exactly that has happened. They've worked their butt off for the 2 years and they've walked away with nothing. And I mean, what a demoralising way to finish the deal. So they sometimes are unavoidable, but they need to be structured really, really well. And you have to have, as the seller, the courage to say, no, the $10 million might sound amazing. Oh, I'm getting $10 million for my business. But are you really? So,
Yeah, it's
Well,
interesting.
Oh, sorry, just on that, you've also got to think about the tax man there, because the tax man's going, well, pay the tax on the 10 million,
yeah.
because that's what the contract says.
It's a tax day these days, but
The
that's
tax
right.
day. Sorry to pronounce it.
Yeah, I think I'm old enough to get away with that joke. I was going to say, I hear what both of you are saying. One thing that I've seen quite a few times is people, and this gets to a little bit what Ian was saying, people just hanging on to their business because my business is worth $2 million and I'm not going to sell it for a penny less.
Yep.
And then I'm thinking, for example, a transport business, just because it's an easy example, an easy illustration. They hang on, and in the end, they don't get the buyer, and they're going to Ian they're going, can you just sell these trucks? And basically all you're getting is truck value. All right, just.
Can I just add to that?
Yeah.
We've probably done 10 auctions this year of literally across engineering, transport, where the buyers just basically, the owners have just said, we're 68, 70, 72, 73, can't find a buy, employed a business broker, whatever reason it didn't work, just come and auction my assets. I own the property, I'll get my super out of the property, I'm done and dusted. So there's a lot of that type of thing happening.
Sorry, just say your name and your firm.
Richard Hemingway from the Blue Capital. I'm sorry, gentleman from Coleman Beg, I've forgotten your...
Malcolm, yep.
Malcolm, I asked, in the deals you're seeing, what I'm seeing in the market is more and more of the, let's say, corporate type mechanisms, the earn-outs and those sorts of things are finding their way, trickling down into the sort of SME.
So the question was just that typically the earn-out or delayed payment structures have sort of originated in the corporate world, but you're seeing in the market that they are trickling more and more so down into the SME space. Am I seeing that as well? Absolutely, absolutely. Very much so, where it is a larger player seeking to acquire the smaller business as a strategic acquisition. Absolutely, it's almost the norm now, rather than the sort of one-off. It is very, very common. It is difficult, again, if it is that buyer's market, it is very difficult, particularly if we have older practitioners, older business owners. I mean, I can tell you, for example, vets. We have, the average age of vets in Australia that are running their practices is way over the national average of the age, and we have this glut in the market of veterinary practices that are looking to retire, and we have these larger corporates. There is about 3 or 4 of them in the market where they are just gobbling up practices. It happens in the medical space as well, and every single one of those deals has earn-out provisions in them. Not vendor finance, nothing like, it's earn-out provisions. and it's if depending on who you are in terms of your sell, how quickly you want to sell, what your personal situation is, it can be very hard for those that haven't done their homework and aren't prepared and need to sell relatively quickly. It's very hard to resist.
Yeah, interesting. Yeah, very interesting. It's funny, when we're talking about earnouts, I know that finance brokerages themselves, as businesses, sometimes are difficult to sell. But some of the successful sales I've seen have been earnouts. Because in that scenario, you know, it's all about retaining the clients and all that. So look, we'll you wanted to add something?
I was just going to say, I know it sounds like I'm being overly negative on them, but I have seen many work very, very well. Yeah. Had a couple of recently where I diarise the dates and I'll pick up the phone to the client saying, how'd you go? Like, are you getting close to the number? And the last 3 or 4 have said, yeah, killed it, no worries, all good. So they can work if they're structured well and the seller knows what they're getting into.
All right, Ian, what I want to get to is well, firstly, I think you said you've made 6 acquisitions. 2 have gone well. So I think I don't know, the guys might correct me here, but that sounds like above average. Because a lot of them don't go well, I think. What do you think, what are people doing right and what are people doing wrong?
I think I've always bought business. So the first 2 businesses I bought were literally payment up front. One case, the proprietor had cancer and subsequently died a few months later. That was an engineering business. In that case, I just chose the wrong partners. So I was a 25% equity holder, knew one of the guys extremely well, the other 2 not so well. No structure, no business plan, and I was an outsider. They were going to be working in the business. So that ended up in tears. 2, the most recent where I bought a healthcare valuation practice. That was on an earn-out, paid some money up front, probably about a quarter of the price up front, but on a revenue generation basis, not on a net I think net profit is a real issue. That's where I wasn't looking to screw the vendor, I was looking to get a win-win situation, so we worked on gross revenue. That has worked extremely well for the last 3 years. We've got a vibrant business in that space and it's got a great future, and he will hang around hopefully in a part-time capacity for some years to come. An auction business down in Canberra where we did no due diligence. It was actually had a liquidator appointed at the time when I did the deal. We weren't able to do any due diligence and we found a whole series of legal issues that we had not investigated, which took us about 4 years to clean up and cost me probably 3 times what I paid for the business to do that. So that was a very unhappy, and that's where I learned about have your lawyer involved almost from the very first discussion, even coming to meetings to just clarify and point you in the right direction, because even though I'm a chartered accountant and I've had a lot of years in my own businesses, it's a different perspective and a different world, and I think if I'm looking at a practice in Melbourne at the moment, that will be a similar structure to this last one. I think also there's a big difference between professional services and what I call hard industries like manufacturing, like transport, where the physical assets of the business in those areas are much more significant. We don't have a lot of physical assets, so almost everything is goodwill on the professional services side. If you can't retain the customers, you have no business. At least in a transport business, if you lose your clients, you've still got your trucks, which may only be 30% or 40% of the value, but in a professional services sense, you've got nothing. You lose a client. So it's about retention. It's about making sure that the vendor is committed, as I think Malcolm and Andrew have both pointed out, that is committed to the cause. And my goal is I try to put myself in the shoes of the vendor. I want them to be happy. It's really important they're happy, and if there's anything in doubt and it's a little bit, the interpretation could be either way, I'll always go with the vendor's perspective, because it's generally not worth upsetting them to score a small point. It just not worth it.
I think one of the points you made there is you've learned obviously you need to have the lawyer on board. I like to think that one of the reasons people pick up the phone to Hermes or to me is it's not just that we've obviously organised finance, but a lot of people ring me because they know that I know the right person to pick up the phone to. listen, do you know a lawyer? And I think that is a value add that you as an advisor or broker can also bring to the table. It's not just that you arrange finance, but it's also that you know who to pick up the phone to. And I guess that's an important takeaway.
I should just say too that I actually haven't met a lot of people with Andrew's skills, so I tend to think lawyers, but really it's just someone who has a lot of experience in literally running the transactions. So it's a combination of both. And certainly this one in Melbourne, I've got a lawyer involved at this stage. I might even talk to you, Andrew, about that as we get further down the track. But as Malcolm said at the very outset, it's better to pay more on the way in, because on the way out, apart from the cost, it's the time. It's the management time it takes to extricate yourself from those scenarios.
All right, now, Andrew, we were talking yesterday, and Malcolm, it came up, Malcolm was talking about he gets a lot of people are coming to him for the legals because they're selling their business, and he's like, the business is nowhere near ready, for sale. So I guess, Andrew, if you could just tell us, just at a high level, what are some of the things that you get involved in making a business ready for sale on the sell side, and then on the buy side, where are you seeing buyers making mistakes?
Okay. Apologies if this sounds like a bit of a sales pitch. One of the things that differentiates what I do to most people in the market is I really go in there and say, I am the buyer. So I'm going to give you the buyer's perspective on your business. And for a lot of, going back to Ian's point earlier about the 68, 72-year-old who's just had enough, thinks their business is worth more than what it actually is. A lot of times it's just a reality check. It's just, this is what your business is actually worth. This is how saleable it is. This is where the risks are. And for a lot of business owners, it's a bit of a kick in the pants. It's the first time that someone's told them they've got an ugly baby.
Breathtaking.
But they need to hear it before they go to market, because you don't want that conversation being the one that's being had with the buyer. Buyer has a look at it and goes, no, you've got issues all over the place here. And if that's the first time they've heard it, that's a problem. So, to answer your question, how does someone get ready for sale? First thing is you get someone like me in there to have a look at the business from the buyer's perspective and say, red flag, red flag, red flag. This is what the value is, and this is what would happen if you went to market right now. It's almost like a dress rehearsal. So that's probably the first point. And then to get ready for sale, you take the learnings from that assessment and fix whatever needs to be fixed. It's going to have the most material impact on the outcome. To your second question, where are buyers making mistakes? Buyers, there's a number of reasons why things don't work. 4 out of 6 failures is a pretty good number, actually, because it's usually about...
well done, eh?
I didn't look at it positively.
It can be very expensive. But typically it's ego. So a lot of buyers are out there making vanity purchases, or they purchase companies or businesses that aren't strategically aligned with what it is they're actually trying to do. They buy the wrong businesses effectively, so they make the wrong investment decisions, and they pay too much. So they're probably the 3 key things there. Paying too much comes down to, it can also be driven by ego. It can be that sunk cost argument again. It's already cost me $100,000 to do the deal, so I'll just keep going. And we use an earn-out to bridge the gap and all that sort of stuff, and it just ends in tears. It's not good. But one of the pieces of advice I always give to parties on either side of the table is stay in your lane. If you can't be it's the whole good to great thing again. If you can't be number 1 or number 2 in your market, you've got nothing of value. If what you're buying is not a solid player in that marketplace, what are you buying? Or if you can't turn it into a number 1 or number 2. So it's, as I said, it's got to buy the right asset. And it's a tough market at the moment. Obviously, there's people who are struggling to get a result. Most of the time, I think that's because they're overvaluing their own business. They think it's worth more than it is. It's worth more to them than it is to someone else.
Can I ask you, Andrew? I'm intrigued by AI at the moment. I pay for my ChatGPT.
You're intrigued by it. I'm terrified by it.
Well, I'm terrified as well. Although Zach here, my colleague, tells me he's about 20 years younger than I am. Or actually, yeah, probably more actually. But he's like, no, like it's the industrial, whatever. Everyone survives. But you know, none of us. Well, I certainly hadn't heard of AI or the ChatGPT. I don't know, 2 years ago, say. I've now seen iteration after iteration. We're now up to this new version, and when you actually click on the side where there's other apps, you know, it's like now there's a web browsing, for example, or there's ones that do diagrams, or you could actually take a photo of a set of financial statements, and upload it into ChatGPT and ask you to do analysis. I wouldn't necessarily take that analysis all the way to the bank, but I'll tell you what, it's a head start. So how is that? Is that driving any activity, or you think there's the market woken up to it? How's that affecting value?
Oh, it's too early for that to really have an impact. Most transactions, when they're done, are looking at a 5 to 7 year history of a business. I mean, if you try and sell something that's younger than that, it's a struggle anyway. So if anyone's introducing AI practices to their business now, they'll see the results in a few years' time. From a valuation perspective. So, but no, it hasn't come up in what I've been doing at the moment. But I think it's only a matter of time.
Can I just channel back to something Andrew was talking about before in terms of those older business owners trying to sell their businesses? A lot of them do go to business brokers, and unfortunately, the bar to becoming a business, or the entry point in becoming a business broker, very similar to what it used to be with a financial planner, means that there are very few competent business brokers out there. There's a lot of franchises, and the guys either sit underneath the franchise network, and an owner of a business goes along to a business broker, they get the wrong advice. The business broker just looks at the thing and goes, oh look, it's worth 3 times profit. There's no understanding of whether the profit's a real profit, not a profit, whether it's understated, overstated, whether the directors are taking out market salaries, whether the premises leases are a commercial, non-commercial, are they owned by related parties, all these sorts of things. So I think the other aspect that is a challenge for all of you is where business owners have actually latched onto a business broker, and they create a sense more often than not that they're of this over-valuation of and they support, because they're not prepared to have the hard conversation, because they don't want to lose the sale.
Okay, well that actually, I've got 2 legal questions. We're getting some free legal advice here. It's interesting. Firstly, I'll make just a comment. My wife and I had this sort of thought bubble that we might cash in on the Airbnb market up on the Central Coast and maybe buy a laundrette that was for sale. The moment's gone, so it's not going to happen. But it was being flogged by Bonza business. I can't remember who it was, but they were Gold Coast brokers, and it was diabolical. I think that Catherine's 4-year-old daughter could have pitched this better. I couldn't make head nor tail of it. Now, having said that, the industry is professionalising. There is the Australian Institute of Business Brokers, and I've never met a business broker who's accredited by those guys who isn't absolutely razor sharp. So, but I do agree.
I have.
All right. Well, okay. Okay, but I think at least it's a start. Malcolm, 2 things. The question I wanted to ask you was just to differentiate between buying assets and buying shares at a high level. But before we get to that, and I'd be interested to hear from Andrew on this as well. Let's say you do sign up with the wrong business broker. You've signed a piece of paper, you're committed to paying them a commission, but it turns out that they're absolutely hopeless. How do you get out of those agreements? Or
well, you can. Firstly, I mean, the first thing I would say is you get what you pay for. In the sense that I think one of the big, and I will answer your question directly, but one of the big struggles for many businesses is they just don't have the right people around them. And so they literally don't know who to turn to or what to do, and they fall into that trap of getting the wrong people onto their team because they just don't know any better. And they're proficient at whatever it is that they do in business, but not selling the business or maximising what they get, their return on it. And so we want to keep this positive, but yes, brokers are often the bane of my existence, where they've butchered the deal before it's even gotten off the ground, and you'll get a heads of agreement, or you'll get something, a sales advice, and you're looking at it just saying, what is going on here? So it's just about getting the right people around you is the starting point. Get advice on those documents, because they are very much like the typical real estate agent agreement of doesn't matter who you sell to, how you get the sale, where you find the buyer, you're going to pay the commission. So get advice on the way in on those documents, and stop. If you're not completely comfortable, if you don't feel like you understand what's going on, stop. Don't just keep going along.
I mean, the smart thing is always to show the agreement to your lawyer, for heaven's sake. I mean, as you say, it might cost you something, but what it could save you. And just very quickly on that, as long as you need, on buying the assets versus buying the shares.
Yeah, so critical legal issue. One, you effectively, people struggle with this conceptually, but a business is just an asset. It's a combination of lots of smaller assets, but it itself is just an asset. So if you're doing a purchase of business, all you are acquiring is arguably things of value. Right? You're not acquiring any of the liabilities. It is, I'm just buying this set of assets.
If you're buying the assets, as
yes.
opposed to buying the shares.
Well, there's three different types really. There's the purchase of a business, which is all things required to continue the operation of that business. There's an asset acquisition, which you're just cherry picking bits and pieces of what you might want. And then there's, I am going to buy the shares in this company. Basically, I'm going to take over ownership of the company which owns and runs the business. The big distinction and the easiest way to sort of distinguish that is when you acquire the ownership of the entity that owns and runs the business and the assets, is you are taking it warts and all. You are taking its assets, but you are also taking its liabilities. You are literally stepping into the shoes of the current owners. And if you don't do your due diligence properly, like Ian just said, you walk into a bear trap where you might go, this is a ripper deal, look how good this is, but you end up with, I call them sleeping liabilities you never knew about, all of a sudden become your problem. Something as simple as unpaid tax, unpaid super, a piece of litigation that's going on that you didn't know about, a warranty claim, if it's in manufacturing or something like that, a huge warranty claim that the insurer's already said no to. You take that on, warts and all.
All right. Anything to add to all of the above, Andrew?
Personally, well, I mean, there's other considerations there. One is a tax perspective as well, because particularly for businesses valued under $6 million, they can be eligible for the small business concessions in CGT, and at that time of life, then you can end up paying zero CGT. So the tax practitioner's advice to the vendor is going to be critical in deciding which transaction structure to do. As a buyer, an asset purchase, when we're talking about Australia here, an asset purchase is going to be safer, less risky. However, it's far more disruptive to the business because you have to re-sign every single stakeholder agreement that you have.
Right.
And every client then has to be issued new bank account details, and you're issuing, because you're creating a new co, a new ABN has to be communicated with all the clients as well. And that can disrupt the business, particularly when you've got the change of control provisions or novation or assignment issues. So if you buy the entity, you can generally shortcut most of those. The difference is the sale agreement goes from that big to that big, really.
I talk about front loading or back loading. Getting a sale of business deal and documents together is, in the grand scheme of things, relatively quick and easy. All the work, as you've just explained, is done at the back end. Getting all those customers signed up to new terms, changing bank account details, signing up new supplier contracts, changing the employment agreements. That's back-ended, right? That's where your time and effort is. buying a company or buying the shares in a company or control whichever entity controls that business, it's front loaded. You're doing a hell of a lot of work at the front with your due diligence, with your financial investigations, getting those documents right, getting those warranties. What is the vendor promising to me about this business? That's all front loaded. Then once you sign the deal, it's literally, I'm not going to say a walk in the park because nothing is a walk in the park, but it is far smoother, quicker, easier. So it's either you're front loading it or you're back loading it.
Yeah.
All right, we're kind of running out of time. Just so I've got a sense whether or not I got to go some more questions. Who's got a question? Have we got many questions in the room? We've got a couple over here. All righty. Okay, we've got one over here. I think we'll go to questions. So we'll start with you, Wade.
Wade Oldham. We haven't actually approached the subject of how do you finance a business acquisition. So if you have a business for sale for $2 million, let's say it's manufacturing, so there's some debtors, there's plant and equipment. How does Hermes approach the structuring of that finance, and does the purchaser need to put cash in up front, or would that help it?
All right, so from our point of view, we're looking at, if it's a business buying another business, which is usually the case, we're looking at the assets on the balance sheet of the acquiring of the business that's doing the buying, and seeing how we can leverage those, plant and equipment, accounts receivable, property. Maybe the buyer might have some equity in property that we can take a second mortgage on. Now sometimes the buyer's already gone and leveraged that property to raise the extra cash, so it depends on how they want to go about doing that. So there's the assets of the existing balance sheet. Now often we get also offered the assets of the balance sheet that's being acquired, but then you have this issue if you're buying the shares. If you're buying the assets, that's fine. We can use the assets that are being acquired to raise capital against. Otherwise, you've got whitewashing issues, which we won't go into the nitty-gritty here now, but there is a process. You can't, the creditors of the business being acquired are protected under there's whitewashing. The idea is you can't just sell the business and then strip the money out and leave you, right? So if it's an asset purchase, we can look at the assets on both balance sheets. If it's a share purchase, we can certainly look at the assets on the balance sheet of the buyer. Depending on the legal advice, we might be able to look at some of the assets on the balance sheet. So then it's like, I always say you've got to raise the money to solve the immediate problem, and you've also got to make sure there's working capital going forward. So, what we call runway. So you certainly don't want, it's a little bit like when you're taking off a short runway with the aeroplane, you want to make sure there's enough runway so you don't crash into the nearest mountain. And runway in a business acquisition is enough cash, and probably more cash than what you think in the first place, so that you can still make wages 6 weeks into the thing when it hasn't quite worked out. So then you go, okay, there's a fixed structure. There might be, if you're asking me, we might do a term debt piece, which might be it's amortising term debt over a number of years. Then there's a working capital piece, usually against the accounts receivable. Now sometimes that's not enough, and yes, the owner needs to put in some cash. Alternatively, like I said before, the vendor might be talked into leaving some money on the table, in which case, depending on their trust level with the buyer, we're happy to enter a tripartite arrangement to facilitate or supervise the payment of those. If it's X money, X dollars every month for the next 2 years, we're happy to. It's almost like a DD. It's a DD on their cash flow, a direct debit on their cash flow, is how we go about it. I don't know if any of you guys want to comment. Capital.
The only thing I'd say on that whitewash thing is that the basic concept is if you're ever doing any deals where the target is providing on a share sale, the target is providing a form of security, like a guarantee or whatever. It doesn't even have to be they're borrowing the money. If they're providing some form of guarantee or security, you need to factor in that whitewash procedure, which is going to add about a month to your timeline. So just be aware of that. I've got a current deal where everyone went, oops, wow, forgot about that, and everything has to be pushed out.
I'm a layman, I'm not a lawyer, so the way just to understand the whitewash is everybody understands that if anything goes wrong in a business, the secured creditors get paid first, the unsecured creditors get paid second, and the equity holders, the shareholder in the business, gets paid last. Now, if the owner of the business is selling the business, they've tipped that upside down. They've got all their money out.
That's right.
And so the corporations law protects against that. So there's a process you have to go through. Again, it's a legal thing.
Yep.
If you've got someone buying the shares in the business, as I say, the best advice you can give is to seek advice and certainly give Malcolm a call. Did I answer your question?
Yeah, it does. And to me, it sounds like buying the shares in a business is just the wrong thing to do.
Not always. Not always. It's totally dependent on the circumstances. There are many good reasons to do that. It just depends on the circumstances of buyer and seller, what the key drivers are, what the appetite for risk is, those sorts of things.
There's also tax considerations for the buyer and the seller, right? Because so there are tax considerations on both sides. And sometimes you get people who want to underpay for the assets but overpay for the shares, or vice versa, because if they overpay for the assets, they've got depreciation in there. Matt?
Setting the terms of the earn-out, whether it's 3 years or whatever it might be, but whether it's based on net profit or EBITDA, or what are the pitfalls of some of that. The other thing is the person that controls the books controls the payments on the earn-out. So is the way I see it and have seen it with transactions. So can you touch on that sort of point?
Yeah,
please?
I've seen earn-outs being manipulated, particularly by both parties, really. I mean, if it's measured against net profit, buyers love to load costs onto the P&L just to make sure that the net profit figure isn't going to be achieved. I've also seen vendors strip costs out of their business to make sure they hit their profit numbers, and they end up leaving a shell of a business for the buyer when the earn-out period is completed. So it really doesn't serve either party particularly well if there's those sorts of gaps are there. I prefer to see earn-outs, if they're going to be there, measured against GP. It's above the line metric is better than a below the line metric, and it actually fosters a much better sense of partnership rather than an antagonistic sort of relationship, which ends up happening if it's against net profit. It also means that the business doesn't necessarily have to be ring-fenced. So look, every situation is different, and there's different reasons why the parties are coming together. But it's just detail. You've just got to have the discussions. Be prepared to spend the time up front to really nut out the details of how the earn-out is going to be governed and what it's going to be measured against and what the expectations are, and if they're realistic and if they're reasonable. Buyers love setting high benchmarks, which they know that probably aren't going to be achieved, and vendors get emotionally involved in a transaction and just agree. They get to the point where they just start agreeing with things that they shouldn't agree with.
Yeah.
All right,
thanks.
Is there any question from this side of the room before I go? You guys need to lift your game. No?
I will just add a structural piece, because I think there was a question in terms of structuring. What I don't like seeing, and I think Andrew will agree on me, is a yes-no outcome on an earn-out. It should always be pro rata. It's a sign of good faith. It's not like if you don't hit this, you get zero. That's a ridiculous deal. It should be percentage or prorated. It shows good, that from the buyer shows good faith that we will pay, for the benefit we receive from your efforts. So if it's a yes/no, that's not a fair deal. So if it can be done on a pro rata basis, you're already on a better footing.
Yeah, I always like to see 10% either side of the number.
Yep.
As if you hit that number within a 10% degree of variation either side, then you get your 100% of your payment. Yep. If it's it's 20% or 10% either side of that, then you get 80% of the payment, or whatever the case may be.
So this partly goes to Wade's question as well, of how the thing's financed. I'm just going to come to this side of the room. Sorry, Richard.
Richard, one other question. Just coming back, I guess, to some of the deal structuring, and again, I'm seeing in the market a higher propensity to trend towards share sales.
Now you are at the higher end of the market, just to be clear.
I'm observing right through the market, actually, and seeing that even on sort of SME deals, we're seeing people gravitate towards share sales. Coming on to the indemnity side of it, again, in a corporate context, you've got bankable vendor counterparties where an indemnity really can have substance against it. How do you handle that in both a legal and a sort of contractual commercial sense in terms of ensuring an indemnity is effective if it...
Something that I've seen that not a lot of people are aware of is you can get warranty and indemnity insurance.
It can be quite uneconomic.
Yes.
The market's changing on it,
Yeah,
but it can
it
be
is.
uneconomic
It's getting
in
better.
a smaller deal.
Yeah. The smaller the deal, the more expensive
So
proportionally.
just to make this accessible for everybody, so we're talking about where you do have a vendor finance situation.
Or, sorry, in a share sale scenario, a vendor will be making promises about the conditions or circumstances of a business, and they warrant a really basic ones. They'll warrant that the accounts are a true and fair reflection of what's actually going on. And the document says, and if that's not true, you indemnify us for the cost, loss, all
Whatever
of that
the
sort of stuff,
damages
those sorts of things.
And you can insure against that, but...
Yeah, so the question is, in a larger corporate scenario, they've got the backing to pay up, right? Even if you have to sue them, they've got the money, right? They're not going away overnight. As the deals get smaller and depending on the players involved, what is the warrant? What is the indemnity really worth? Because what are you banking against in that scenario?
Right.
And so the smaller the deal gets, you can get then into the personal guarantee space. So you actually get a person standing behind it. That can be one option. Another option is the warranty indemnity insurance. It is, depending on the size of the deal, can be proportionately quite expensive. The market seems to be getting better in that space. They're two options, but that's a real consideration. You need, what is the indemnity worth?
There is a third option, which is a holdback.
Yes. Yep. Yep.
So basically, the buyer will hold back a certain percentage of the overall purchase price in escrow to cover future warranty claims, and it usually has a time horizon attached to it.
And where does that holdback money sit?
In an escrow account, generally.
With a lawyer?
With a lawyer or something.
Yeah, normally you'd want it in an interest-bearing account, so typically it won't sit in the lawyer's trust account. Might be a controlled monies account or an escrow account.
And have you seen much of that?
Yeah.
I've seen a bit of it in the software space.
Yeah.
Some buyers that do that.
Sort of add to...
No, can I go back to the point over here that Wade made? I still believe that in terms of those measurables, gross revenue is the one thing that a vendor has control of in a sales scenario. They don't have control over costs. As soon as they sign that bit of paper, they no longer control costs, and therefore the system's open to manipulation. And I think it's a show of good faith. As the purchaser of a business, you've got the onus of trying to trade that business as profitably as possible. The vendor has got the obligation to try and maintain the revenue from his existing clients or her existing clients for as long as possible. And therefore, using gross revenue as a measure is a very simple, very easy, non-adversarial way of locking in your vendor to get the best outcome from him.
All right, I think we've got time for one last question. Riyadh. Sorry, we'll just hang on one second.
Thank you. In an SME purchase, how do you differentiate value between the business value and that of the individual key man, which is often the business?
That's a great question. That's a great question. Who wants to have a crack at that? Well, why don't we start with Ian, and then we'll work our way down.
Well, mate, I think anyone that's prudent about buying a business will obviously go and get a valuation before they undertake the process, and that's going to involve an amount of due diligence. And when you're working out multiples, obviously it's a series of risk factors that determine your multiple. One of them obviously is key man risk. So the smaller the business, the likelihood is that the key man risk is higher, which means that your multiple is going to be lower. So that should be reflected in your sale price effectively. And I think that probably sums it up. Basically all of those risks should be looked at as part of the due diligence and accounted for in the valuation, and they should be dealt with almost individually. Each of those risks should be dealt with in the valuation.
It's interesting. I remember there was a cafe underneath where I worked, and there was a German guy who used to call out to the customers as they walk past the street, "Hey, you need a coffee." Or if I was in there having a sandwich and I'm at a table for two and there's a spare stool there, he would say, "You're gonna, this person, you sit there. you know, and he was a real, he really worked it as a small space, and I think only he could do that, you know, so there was certainly a key man element. We'll go to you, Andrew. What would you say to that question of differentiating between the value?
Key man risk, or what I call principal dependence, is the number one area of risk for transactions, particularly in services businesses. Or in that case, the cafe, I wasn't aware of that, that's a classic, I love that. But typically where an owner has had the business for a long period of time and they have personal relationships with their customers, they may not even be the chief revenue generator in the business anymore. But if you've got to take a step back and say, what would happen if I took this person out and they were replaced by either a 2IC or I brought someone in from external? And if it's going to have a detrimental impact on the business, then obviously the valuation is going to be lower. But that's typically where earn-outs, God, I hate them, or vendor finance come into play, because you maintain that commitment that the vendor has to the deal over a period of time. So you've got some time to bed things down, make some changes. As long as the earn-out is pegged against, not against costs, as Ian's already pointed out, it's pegged against above the line measures, then you've got some chance of remediating that over time. But that's one of the reasons why I don't deal with small businesses anymore. You know, minimum profit that I deal with is $1 million, 1 to 10 million. So your size matters. You know,
Yes.
I know guys don't like to hear that, but size matters, guys.
All right, Malcolm, just a quick.
Yeah, I agree with everything that's been said, so I won't repeat any of it, but I'd come back to some of my earlier comments about understanding what it is that you have to sell and getting sale ready. There is actually not a market for every SME. There is not a buyer or a market for every SME. So if you are in a principal dependent business, a lot of small accounting, lawyers, any service-based business, your strategy might not actually be to sell. Well, maybe your strategy should not be to sell, but to have a succession plan. So you are bringing someone up with you to actually have a smooth transaction, and you do some sort of internal arrangement like that, because some businesses just can't be sold in that traditional manner for that risk. The buyer's just not going to take that risk. And we come back to something we've spoken about before about overpricing. I call it the founder mentality. If someone has created or set up a business, it's important to them. It's their baby. They have brought it up along the way through their career. It's worth a lot to them, even just emotionally and psychologically. But some of them just aren't saleable.
All right, well, look, on that note, we're going to close. If you've got more questions, then I'm sure the guys will be here for a little while. Now, I did do a deal with all of the guys before we started, and that is the first phone call is free. So if you've got a question with these guys, I'm sure if you've got a current scenario, I'm sure they'd be happy to take a call from you. Goes for myself as well. Thank you very much to everybody for coming along. So, and if you just give me a round of applause for our speakers. All right. Thank you.